Hi everyone, welcome back to the HFAC comp. In the last video, we talked about accrual accounting and compared it to cash accounting. In this video, we want to delve into the first of three financial statements, the income statement. The other financial statements we'll be looking at over the next few weeks will be the balance sheet and the cash flow statement. Now, the income statement really measures the inflows and outflows of a company, especially in the operating segments, or how the company actually makes money. And we can really think about it as a funnel of some sorts, or a coffee filter, or a set of coffee filters. We start with the amount of revenue we have, and we slowly remove all our expenses until we get to our net income number at the bottom. And we'll talk a little bit about net income today, but we'll mostly save it till when we get to the cash flow statement and the balance sheet, because it becomes a little more important then. So right now, I've laid out a basic, very basic income statement. If you look at income statements from FactSet or from the SEC, just like we showed in a few videos ago, they might look a little different. But this is the general structure that you will see. Some of these line items may or may not be included, and there might be other line items that are included. Remember that if you have any questions about a specific line item on a specific company's income statement or any financial statement, there's often a notation in the document that you're looking at, whether that be a 10K or 10Q, that indicates what that line item is for and has a little bit more information on it. But let's start looking at our income statement and start with the top, the revenue. This is pretty much what it sounds. This is how much money did a company make from selling a certain product. So for Apple, this is the amount of money they made from selling iPhones, Macs, iPads, Apple Watches, AirPods, etc. That's all revenue. That's a pretty straight one. We sometimes call this the sales, net sales, top line. These are all very common terms here. The next line item is the cost of goods sold, or what a lot of people like to say, COGS. And this is the actual cost of creating the item. So for an iPhone, let's continue actually with this iPhone example throughout the rest of the video. An iPhone, the cost of goods sold for it is going to literally be the actual raw material that goes into the iPhone, the box the iPhone might be in, the labor in the factories to build the iPhone, but it's not going to include the research and development or the engineers who sit in Cupertino who actually make the iPhone. We'll talk about where those fit in the income statement a little later. From this, we come to gross profit. And with gross profit, we can calculate something called a gross margin. So gross profit is simply revenue minus COGS, and gross margin is the gross profit over the revenue. So that is gross profit. Now, let's delve into expenses. So like we said earlier, the engineers who design the iPhone who sit in Cupertino don't fit into the cost of goods sold. So where do they go? They go under the expenses category. And we're going to talk about 4 kinds of expenses in the HFAC comp, but there are other kinds of expenses that are beyond the scope here. So the first one is selling, general, and administrative, or often termed SG&A. This is the marketing expense of a company. When Apple has staplers for their employees to use, where does this go? That's a general expense. Who's paying the executive salaries? That's also an SG&A expense. What about like assistants and secretaries? Where do they fit in? Those are all SG&A expenses. This can actually be a pretty large portion of expenses because remember, it includes like whole marketing departments, sales teams, executive compensation. All of that gets bundled into SG&A. So remember, SG&A, selling, general, and administrative. If it doesn't necessarily go into the product, it will either go into SG&A or R&D. So the next one obviously is R&D. Now this is the engineers working to develop the products. Again, the people who sit in Cupertino, in the Apple Spaceship campus, their engineers are going to probably fall under the R&D expense line. This is how we build and develop the product. Think about companies that have very high R&D but very low COGS. A lot of your tech companies, right? Think about Facebook. There isn't that much of a cost of building anything because there's no physical product necessarily, but there is a really high research and development cost and a really high SG&A cost. So that's a really good example in tech companies to really think about the difference between COGS, R&D, and SG&A. But compared to a car manufacturer, sure, there is definitely a lot of R&D, but there is also a lot of COGS because there are a lot of raw materials that go into building it. The next 2 expenses are depreciation, amortization, and impairment. So those are expenses 3 and 4 here. Depreciation and amortization you might often see called D&A. And I think the best way to explain this is again with an example. So let's say if Airbus, again, coming up from our example from the last video, invested $50 billion US dollars into new factories for future production, and we recorded the entirety of this amount as an expense on the income statement. That would eliminate the company's profitability for a given year. Do you think that's really fair? No. So like we've talked in the last video about accrual accounting, we will also use an accrual approach here. We're going to expense that $50 billion investment over the useful life of an asset. What is a useful life of an asset? That's a great question. That's how long we expect that we can actually be able to use an asset. So let's say, for another example, that Comcast buys a truck, a Ford F-150. How long will they be able to use that truck for? Well, they'll be able to maybe use that truck for 10 years. So they can expense it over 10 years as a depreciation, and then they can depreciate the value of it over those 10 years, because after the useful life, you kind of have to throw it away. So we often use a straight line depreciation and amortization where we'll distribute the useful life in a linear manner. So if something costs $100 and we will straight line DNA it over 4 years, we'll take $25 one year, $25 the second year, $25 the third year, and $25 the fourth year. There are other DNA methods you can use that are non-linear, that actually have a little bit of a curve to them. An example might be a car. When you drive a car off the lot, a lot of the value is lost at the beginning, and then it might retain its value a little better. So that's a different example where you might not want to use a straight line DNA. But under general GAAP accounting rules, we'll tend to stick with the straight line DNA. If there are cases where non-straight line DNA is being used, again, like I said earlier, you can always look at the notes in the financial statements, and they should outline that over there. But this is for depreciation. So depreciation deals with physical assets. The next part is about intangible assets. The same concept applies. So let's say Michelin, the French tire company, just developed a new rubber technology and acquired a patent. Because this patent will be useless after 20 years per the law, so patents expire after 20 years, the accountants at Michelin will amortize this patent over 20 years. So every year, the patent is going to lose a certain amount of its value. Because after 20 years, the useful life is gone. So we see this exact same concept here in intangible assets. We might also sometimes see amortization of brand or of logos or something like that. Might be, again, intangible assets where you can amortize. Now, what happens if an asset is destroyed? So let's say Comcast has been using that Ford F-150 truck for 5 years. The remaining useful life of the truck is 15 years. However, it is swept away in a hurricane, and it was not insured for whatever reason. Thus, the entire value of the truck is written down, set to zero, and the company recognized in the impairment equal to the value of the truck over its remaining life. So we got 5 years of value of it. The remaining 15 years of value, we're going to have to mark it immediately. We cannot mark that value over a year-on-year basis anymore. We have to mark it in 1 year because we lost the asset. So we're going to note this as an impairment charge. We often see an impairment charge if an airline has to write off like an aircraft because it was damaged significantly. That is going to be impairment as well. So overall, we looked at 4 different kinds of expenses here. We looked at SG&A, selling, general, and administrative, R&D, research and development, D&A, depreciation and amortization, and impairment. Now, after we subtract all these expenses, we will go to EBIT, or earnings before interest and taxes. Before interest and taxes, because interest and taxes come below it. So the calculation for earnings before interest and taxes, or EBIT, is revenue minus COGS minus your operating expenses. Remember, these operating expenses are SG&A, R&D, D&A, and impairment. Why do we call these operating expenses? Because these are the expenses that it takes to run the business. You can't have Facebook without the engineers. It just doesn't work like that. So that is an operating part of the business. You can't have Apple without paying the CEO salary or the marketing teams. So that's an operating part of the business there. After this now is where things get a little murky. So next we have interest expense. So a lot of times companies will take out debt in the form of bonds. They can issue bonds. They might take on loans, etc. Now, we don't mark their repayment of the principal on the income statement. We'll talk about that on the cash flow statement. All we're going to mark on the income statement here is interest expense. What is the interest that they're paying on their loan? Right now, yields are very low, so interest expenses might be very low if you go and get debt right now. But in the future, interest expenses might be a lot higher. So we're just going to mark the amount of that they're paying for interest on here. Remember, this is not the principal. We'll talk about the principal later. Next, we have income taxes, and we will now pay income tax on whatever the amount of income was after all these other line items were subtracted above here. So remember, it's like a funnel. We only pay income tax on what is above. So the more interest we pay on loans, the less income tax we're going to pay because we're going to have less taxable income. The more depreciation we can take on certain assets, the less income taxes we'll have to pay. Sometimes if you're filling out your personal taxes, you actually have the option to mark out depreciation and amortization. So maybe you have an asset that depreciated very quickly, and you took a huge amount of depreciation. You can actually reduce your income tax burden because of that over there. So right now in the United States, income tax, the corporate income tax stands at 21%. Before the 2017 Tax Cut and Jobs Act passed by the Trump administration, the corporate income tax was 28%. So in interviews, if you're going through that process, normally you'll either use anywhere from 20 to 40%. Just ask your interviewer and they'll normally provide a number that makes the math a little nicer over here. So now, with that, we come to our last line item, which is net income, which is pretty much the total income of the company after we've taken out our operating expenses, interest expenses, and tax expenses overall. Net income is going to be a little more important because this net income is going to flow into our cash flow statement. So we're going to really delve into it a little more over there. So let's just recap what we saw in the income statement. We start off with revenue, which is effectively the stuff that we sold, how much money we brought in. Next is the cost of goods sold, which is the amount of money it took to produce those goods. Again, if we're talking about iPhones, the labor necessarily needed to produce it, the raw materials, the box, etc. That leaves us with gross profit. Next, we'll take out our expenses or operating expenses. We talked about 4 kinds of operating expenses. The first was selling, general, and administrative, which is the marketing expense, executive pay, who pays for the staplers in the office, etc. That's SG&A expense. The next one we talked about was R&D, research and development. Who's paying the engineers who are sitting in Cupertino to develop and design the next iPhone? That is considered an R&D expense. After that, depreciation and amortization. That's how we take out the expense after the useful life of an item decreases. So we will amortize or depreciate over the useful life of an item, normally using straight line depreciation. And the last one we talked about was impairment. When an asset is destroyed, we need to mark it out as an expense because we can no longer use that asset. After that, we have interest expenses. Remember, this is not the expense on the principal of any debt. This is just the expense on interest. Lastly, we have income taxes. Right now, the corporate income tax rate stands at 21%. So you'll pay your income tax on everything above, all the line items above. Think about it as a funnel. You pay on what's above on your income taxes. And that will leave us with net income, which will flow into our other financial statements. So that's pretty much all it is here for the income statement. This is the first and pretty easy statement to understand. And we will now move on to our next video. Next week, we will talk about the balance sheet. So till then, see you next time. And sections will be starting soon. So have a wonderful section and have a great week.